And then when we get into dividend yield fund, that is, I think everyone have a hope that when I invest some money, I need to get something back.
Yeah.
And dividend yield fund is something which kind of really reflecting that kind of a motivation also. So could you let us know that what is a dividend yield fund and what investors can expect from this kind of funds?
Sure. So essentially, a dividend yield fund invests into companies which are high dividend paying. The way I would want to explain this concept is that just imagine there is a business which has a very high growth potential. Whatever it is earning, it wants to reinvest that money for future growth. As against this, there is a business which has reached to a stage of maturity, which is growing at a very modest rate. Therefore, it does not need the profits that it is generating for reinvestment. Such a business would like to give the excess profits as dividends. And therefore, high dividend yield companies are the ones which have reached a stage of maturity, and therefore they don't have avenues for utilizing their profits for future investment. Therefore, they like to pay back the excess profits to their shareholders as dividends. A dividend yield fund tries to invest into high dividend yield companies. Now, because these high dividend yield companies keep paying strong dividend, that becomes the source for such kind of funds to pay back to their investors what we call as IDCW these days. In a way, it's another term for dividend distribution or income distribution.
Okay.
Yeah.
So those who are looking for that kind of income, this will be one of the good fund, and at the same time they can opt for IDCW. And so here they won't have a fixed money coming in based on that dividend coming for that particular fund, they will get it.
Yes. As against, let's say, if there is a flexi cap fund that we are comparing to a dividend yield fund, I would say the ability of a dividend yield fund to give some regular income by way of IDCW would be better or higher than a flexi cap fund.
Okay. Okay. So here focus is mainly to get that kind of a stock which give more
dividend income, which can be passed on to investors.
Yeah, I think those who have pretty decent wealth also, and they want to plan for the retirement.
Yeah,
I think this could be one consideration they should give to their allocation.
Absolutely.
Maybe. Okay, that's good. That's good. And when it comes to we have a method of withdrawing money, right? SWP and IDCW. So which one will be your preference? SW versus IDCW?
That's a very good question, Nikhil. It goes back to asset allocation and it goes back to unique investor requirements. If you're talking about somebody who's 70 or 75 years of age, I would say he or she may need both. Of course, dividends would be more tax friendly. SWP may not be so tax friendly because when you take money out, there would be an incidence of taxation. If you're talking about somebody who's 30 years of age, I would say he or she should go for none.
Yeah, right. Growth.
Because, exactly. Because this is an age which we call as age of accumulation. You are accumulating all your savings and you don't need this money not until you are 55 or 60 or somewhere around that age. So, very client specific, very investor specific question. Some investors don't need anything. Some investors may actually need both because they have reached to a stage where they don't have any regular income. Therefore, they need some regular income every month or every quarter. At the same time, to meet up with certain big expenditures, they may also need the help of an SWP. So yeah, I mean, I would say this is also an important asset allocation decision and the decision of dissavings or, taking money out of the pool that you have created for yourself over the previous 30, 40 years is an important decision, which again must be discussed with the advisors and distributors.
Correct. I think each and every individual is a unique, and I think we need to have a clear discussion on that.
Absolutely.
And this one, since you said it, sometimes income is not required. I think this is one small confusion among investors because there are people who are, even yesterday also I was handling to one client, and because he's having a decent salary, and retirement is, I think, next 20 years or 25 years, but he want to take SWP.
Right.
This is just for, then I asked why do you really want to? So he said that getting an income is a more confident, it seems. So just for the confidence. So,
Right.
What is your, little more explanation what you have said, why you don't really need to start taking income from your mutual fund besides growth.
So the first thing, Nikhil, I would say would be taxation, right?
Correct.
So one has to be cautious about the element and the incidence of taxation. That's point number one. Point number two is, well, there is a mental satisfaction in converting your paper gains into real gains, but then once the real gains are in there, you have to reinvest once again. Sometimes the reinvestment decision may not happen immediately. It may hold on for 3 months, 6 months. During that time, maybe the market moves up, you feel left out, and then after the markets have moved up, you don't feel like investing immediately, so you hold on for some more time, and who knows, markets move up even further. So as we typically say that, for money to compound, you have to leave the money untouched without interrupting the compounding. By revisiting this decision of should I book some profit, should I take some money out, you are interrupting the compounding of wealth, which should never be the case. Not at least till the point of time that you actually need the money. The urge to convert paper profits into real profits is a very wrong urge. And like I said, it interrupts compounding. That should not be the case.
Yeah, I think this is something which a lot of people have this confusion that, some said to me more like a complaint that you advisors or you distributors only ask to keep on investing.
Yeah.
You are not saying to book the profit.
Right.
And most of that expectation is that you need to time the market. You should know that when that reaches the peak, you should exit. When it comes down, start investing again. That is a kind of hurdle is most of the people are expecting. And eventually, it's not really possible also.
Absolutely. It's not possible. You may be right once, twice, thrice, but you can't be right all the time. In fact, you will be wrong at least 50% of the times. And, do remember when you book profits, you have to make two decisions. One, when to book profits, and two, when to re-enter. So you are increasing the number of decision-making points, and in life, it's always reducing the decision-making points that helps.
Okay, that's a valid point. And it's a very simple way you put it, but I think this is something which all of us has to understand also.